Welcome to section series. Today we are going to talk about IAS 36, Impairment of Assets. Let's dive into today's lesson. So let's look at the objective of IAS 36. The objective is to set the rules to ensure that assets of an entity are carried at no more than their recoverable amount. No more than their recoverable. We'll look at recoverable amount very soon. But let's look at the condition for impairment. When we say impairment, what does it imply? What does it imply? And what is the condition for impairment? We say an asset is impaired if its recoverable amount is below the value currently shown on the statement of financial position. That is the asset's current carrying amount. So basically, the condition for impairment is that the recoverable amount is lower than the carrying amount. So in the case whereby recoverable amount is lower than carrying amount, it implies that impairment has occurred. So in this case, there is a need for you to apply the concept or the rules in IAS 36. So yeah, what do we then do in this case? So let's look at recoverable amounts first. So recoverable amount here is also seen as a value which is higher of, number one, the fair value less cost to sell, which is also termed as a net realizable value. So fair value less cost to sell is sometimes referred to as the net realizable value, and then value in use. Let's look at each of these. Fair value less cost to sell, what does it imply? And then value in use, how do we estimate all these? Now let's look at the measurements. So how do we estimate? Let's start with fair value less cost to sell, which is also termed as a net realizable value. Now, to measure the fair value less cost to sell, we measure it by using a binding sale agreement. So the time whereby there's a sale agreement, based on the price stated in the contract, that price becomes the fair value, and then any cost we incur in that particular contract becomes the cost to sell in that particular sale agreement. And then the current market price less the cost of disposal, and yeah, this basically applies in an active market. So whereby we have the price of that particular non-current asset, we'll pick it and then we'll less its cost of disposal from it. That's the cost we incur when we sell the asset as well. Let's look at the next one, which is the value in use. How do we estimate value in use? Now, value in use is determined by estimating future cash inflows and outflows to be derived from the use of the asset and its ultimate disposal, and applying a suitable discount rate to these cash flows. So what does this whole thing mean? So with the value in use, you need to estimate the future cash flows of the particular asset. So the future amount of this asset, we need to estimate them. So once you estimate this future amount, there is a need for you to discount this future amount to what's present value, and you do this using the discount rate, or what is also termed as the discount factor. Now, how do we calculate for discount factor? Discount factor is basically 1 over 1 plus r raised to the power n, where r is the rate, and then or the cost of capital, and then n is the number of years. Now let's look at some indicators of impairment. Now, the indication may be derived from within the entity itself, which is termed as the internal source or internal indicators, or the external market, which is termed as the external indicators or external source. Let's look at the internal source of indicators of impairment. So in the internal source of information or internal indicators of impairment are, the first one is that there is evidence of obsolescence of or damage to the asset. So in terms of we, the entity, when we are able to make evidence or show that there is obsolescence or there is a damage to the asset, we can basically say that clearly impairment has occurred. Also, when there is changes in the way the asset is used have occurred or are imminent. In the case whereby the changes is quite visible and you can see clearly, then obviously impairment has occurred. Also, when evidence is available for internal reporting indicating that the economic performance of an entity is or will be worse than before. So whereby there is evidence that the benefits we derive from that asset will be lower than the value reported in our statement, and clearly impairment has also occurred. Let's look at some external source as well. So the external source number one is whereby the asset market value has declined more than expected. So here is left for the with the external market. So in the case of the external market, whereby the asset value has reduced, then clearly there is impairment of the asset value. This one is caused by the external market. Second one is also when there's a change in the forces as well. So here the forces, we are talking of technological, market, economic, or legal environment that have had an adverse effect on the earth. So these changes, as maybe changes in these forces, have brought an adverse effect on the entity, and clearly impairment will occur. Then the third one, whereby income rate have increased. So in the case whereby income rates have increased, when income rate increases, basically discount rate also increase, and this will affect the value of the assets and basically its value in use specifically. Now let's look at a question. Now on 31st December 2018, an entity noticed that one of its items of plant and machinery is often left idle. On this date, the assets had a carrying amount of 500,000 and a fair value of 325,000. The estimated costs required to dispose of the assets are 25,000. If the asset is not sold, the entity estimates that it will generate cash inflows of 200,000 in each of the next 2 years. The discount rate that reflects the risk specific to this asset is 10%. So here, in this case, we have the carrying amount of the asset, which is 500,000. We have been given the fair value here as 325,000. We also have the cost in which we use to dispose, which you also term as the cost to sell. In this case, remember, dispose means sell, so cost to sell in this case, which is also 25,000 over here. And you have been given a cash inflow of 200,000 here, and the question, the cash inflow is each in the next 2 years. So meaning that for 1 year it's going to be 200,000, for the next year it's also going to be 200,000. We have also been given our discount rate, which is for 10%. Now let's look at the requirements. So required: A, we are expected to discuss the accounting treatment of the above in the financial statement for the year ended 31st December 2018. So yeah, basically we are going to account for it using the impairment rules over here. Then B, how would the answer to part A be different if there is a balance of 10,000 in other components of equity relating to prior revaluation of this specific asset? So yes, whereby we have to add some explanations to the answer. So let's dive into the A first. So A, let's start with our workings. A will first bring a schedule which will help us to estimate for the present value. We are looking for the value in use in this case, and value in use, we need to first use our cash flows. We bring our cash flows and we use a discount factor to give us the present value. So here with the year 1, the discount factor will be 0.9091. How do we get 0.9091? Remember the formula: 1 over 1 plus r raised to the power n. So r here is what, 10%, so it's going to be 1 over 1 plus 10%, and we are doing it for the first year. So first year, the number of years is only 1, so 1 over 1 plus 10% close bracket raised to the power what, 1, and that will give us the 0.9091. And the cash flow per the question is for 200,000, so we multiply 200,000 by the 0.9091, and then we'll get 181,820. Let's go to year 2. Year 2 will be 0.8264 multiply with 200,000. That will give us what, 165,280. And then the value in use, we're going to sum the present value up, and then we had 347,100 as 347,100 as our value. Now let's calculate for fair value less cost to sell. So fair value less cost to sell. But the question, our fair value was 325,000. Then we will less the 25,000. So we are going to get fair value less cost to sell to be 300,000 Ghana cedi. Then here we will look for the recoverable amount. Remember, recoverable amount is what? higher off. So we'll look at the two values. Which one is higher? So value in use here is 347,100, and the fair value less cost to sell here is what, 300,000. So the higher value obviously is what, 347,100,000. Yes, so it's the value in use. So our recoverable amount here is going to be the value in use, which is what, 347,100. Now let's go to the impairment. How do we calculate for the impairment now? We code the formula. Impairment here is going to be carrying amount minus the recoverable amount. Remember the condition for impairment. We say impairment will only occur whereby what the recoverable amount is what, lesser than the carrying amount, meaning that the difference will give us the actual impairment. So to now go, our carrying amount is what, 500,000, we're less by the recoverable amount, which is 347,100, and then we get impairment as what, 152,900 Ghana cedi. So that will be our impairment. Now what's the treatment? So basically the impairment will be sent to what, profit or loss as an expense. So the entity should debit profit or loss with what, 152,900, and then we are going to credit PPE because it's going to reduce the value of our assets. So we are going to credit plant, property and equipment with what, 152,900 Ghana cedi. So in the statement of financial position, the recoverable amount, which is what, 347,100, will be the carrying amount of the property, plant and equipment, because to reduce it up to 347,100, basically that's the implication. So let's move to the B aspect. Remember with the B stated that here there was what, a revaluation. There was an existing revaluation in our books which was 10,000. So here what it implies that whenever there's an existing revaluation, it means that this value needs to be cleared off first. So it needs to be written off from our books. So in this case, the 10,000 which was recorded in OCI needs to be debited. So we need to debit OCI, which is the statement of other comprehensive income. So we debit OCI to cancel off the amount, and then the difference will now go towards our profit or loss. Remember, you are expected to debit, ideally you are expected to debit profit or loss with the value of the impairment. But since we have a revaluation surplus or revaluation gain in respect to the asset which was impaired, there is a need for you, number one, to first write off the amount in OCI. So we debit OCI by the 10,000, and then the remaining amount will be sent with profit or loss. So the next one, the remaining, so we debit profit or loss with what, the remaining. So the total impairment figure was 152,900. We less what, 10,000 from it, and we will record the remaining what, 142,900, and then we'll credit our property, plant and equipment with the impairment value, which is 152,900. Thank you.